Welcome back, everybody, to this week's King's Crowd Investment Roundtable. This is your weekly dose of startup investing and online investing insights and news. We will cover something great happening in the news every week, relevant for both investors and founders and other people in the industry, and also talk about our deep dive chart of the week. This week, we have two great topics. So on the news front, we're going to be talking about the SEC statement that was just released in the past few days on meme coins. On the chart of the week front, we will be going into testing the waters, basically looking at some of the data across the top two platforms and some of the trends and key takeaways for investors and founders. Scott, I will bring you into the discussion here to help kick things off on the meme coin discussion. I know you have no strong opinions there, but to bring everyone up to speed, the SEC Division of CorpFin, that's corporate finance, basically announced that meme coins are not going to be regulated as securities. I've got some opinions. I think we could bring in some others as well, but why don't you kick things off? Where are you on this? Good, bad? What does this mean?
I think I'm going to surprise people with this hot take. I think it's fine. I think that we are entering I understand that finance needs very firm regulation for a lot of reasons. We got to protect people. I genuinely, including King's Crowd users in particular, I believe that. I mean that. But we are entering a place where there is ambiguity. We're entering a place where there are more than 1 million people every day making bets on events on Polymarket and other such platforms. They are on a fiercely regulated platform, Robinhood. They did that not all the time and not every deal, but they did that for the Trump election. We have billions of dollars trading every single day gambling. I have friends who are sports fanatics and they don't know shit about the things that they spend thousands of dollars on. How is that any different? And I think that it's actually more clarifying when you say a meme coin is not a security and it's completely speculative and it's just basically gambling and you're dicking around and that's fine. I actually think that creates more clarity for the stuff that we talk about every day on the equity side and be like, nope, that is a security. Nope. You can't do a rug pull on something that's asset backed because you will have to face SEC regulation, federal crime, much more strictly governed. And I think that's a big part that I'm going to leave to Brian and you guys to talk and rip through because it's a big part of what we do every day. But the last thing I will say to this, I have been saying this for several years and I don't know if I said it. I don't think I said it trying to be right. I think I just said it because it was it felt that way. We are entering kind of a community phase of social media. Everything's about niches and building movements, and some movements pick up and maintain steam and some don't. And I don't think I don't think there's anything wrong with somebody creating a social moment and then having a shit coin behind it. And if people want to back it and pile into it for fun and believe it's going to go, you could lose your money just the same. Some people will make a lot of money overnight. Some people won't. And what I would say to you is, boy, that sounds a lot like the lottery. And to me, it kind of feels that way. And so I actually think it creates more clarity for the assets that we do care about. I understand that there's probably a gazillion flaws in my position here that I haven't even read about, and I'm about to find out firmly from the three of you. But I really do believe that this helps clear the way for some of the real assets that we all want to invest in, and we can point and say, that's what this is. So then all this other stuff is bullshit. That's my take.
All right, so I want to bring in our King's Crowd Senior Investment Associate, Teddy, here for discussion. But real quick, I think it's important to define in the eyes of the SEC. SEC is the Securities and Exchange Commission, right? What is a security? So the common test that the SEC uses is called the Howey test. And basically there's 4 criteria. It has to be an investment of money into a common enterprise, so something where there's other people investing in it, with an expectation of profits. That's number 3, and it has to be mostly derived by the effort of others. So in general, that's how the SEC and a lot of people will define securities. Now, in my eyes, I don't think this is necessarily saying that meme coins are always going to be okay. And you brought up some good points, Scott. Who's to say they aren't? If an influencer wants to create a token or something and give it to people who are excited about them. But at the same time, there's the other side of scams and rug pulls. So
I think there's a difference to what Scott's saying, where it's like an influencer trying to take advantage of the moment making a meme coin, like it's shit. Everyone knows it is, like, and people throw their money at it because it's a joke. But like, there are like multi-million dollar scams. Like if you watch any CoffeeZilla video, he like goes through all these in depth. It's like someone that creates a meme coin, they pay a spokesperson to like talk about its utility and like how it's going to change, like be involved in this game that's going to be really amazing, like Crypto Zoo or something. And then it's just, and then immediately gets rugged, and it's just like kind of objectively fraud. So that's what I think needs like the regulation. And I guess it's probably not from the SEC. It's probably, I don't know, like its own institution to regulate it, because it's right with fraud. And I don't know if like the DOJ and the FBI like have enough time to hit those, but I don't know. I think it gives crypto like a super bad look when this happens. Yeah.
Yeah. So like this is Teddy, I agree with you. And actually this kind of like emboldens my point here. It isolates the fraudulent deals. Like let's just say hypothetically 48 hours before you were to become elected president of the United States and you launched, I don't know, a crypto token on a Solana blockchain, and then somehow later launched your wife's token, and then like a couple minutes after that you actually announced a reserve that included the exact token infrastructures that you ran your previous oh sorry, that happened in real life. That kind of stuff starts becoming branded and known. It makes it to where the people who have the most to lose in crypto police themselves, which they previously kind of haven't. It's sort of been like, well, you know, it's a cool project, we back it. Everyone knows the gig is up. If you have trillions of dollars in assets and all of a sudden people are pulling rugs that will like ruin your project, I think you start to be like a little bit more shrewd about who you're doing business with. So I think that's one. And then also, by Teddy almost literally defined it here when he said it's like this like weird thing that's not quite SEC, but it's not quite this. And but what ends up happening is it's very obvious when an outlier. If everything else has a name, if it's a security and it's treated like a security and it's a real world tokenized asset on a recognized blockchain traded by Chase Bank, it looks like X. If you pull a rug or you do something nefarious, I can call this one, it's chapter X, it's this thing, it's this whatever, and they deal with it. The isolated incidents of the outliers, which are just like very clearly defined by fraud. And I just think like I don't know how we'll address them, because I don't think we've seen all the tricks yet. But like we're starting to see kind of a regular theme, the Haktua Girls coin. You're starting to see all this, like they all kind of look the same. And I do feel like we're in a place now where maybe we can actually like identify ahead of time when something is probably nefarious versus something that's fun. And right off the bat, you can put a label on it that says like, hey guys, this is not a security. So like, you're probably gonna lose all your money. Gamble as you would like. And then when somebody goes and does an actual like crime, you know it when you see it. So this like creates clarity almost by not having clarity, if that makes any sense.
Yeah. And I just to pull this back, if someone's just joining us and like, okay, hey, why are we talking about crypto right now or meme coins on the King's Crowd podcast? These regulations that are in place to be able to allow companies to raise capital online, right, are there for many important reasons. And one of them is investor protection. And I was talking to someone this morning and they were saying that they, have friends who decide to go through and do a token offering because they know they're not going to have to jump through all the hoops that they have to jump through to do a regulated securities offering. Now that is not okay necessarily, right? But I think what this is giving clarification on, while the SEC is saying that it's not a security, they're not saying that it's okay. They're not saying that fraud might not still be going on, but it's like, this is just a different asset. You can't think of it in the same bucket as companies that you're looking at online, right? And so I think we will see more clarity also, where eventually they're going to have to say, if a company wants to do a token offering and you have like RWAs, real world assets and other things, coming and being tokenized, those are going to be treated potentially as securities, right? All right, with that, let's wrap things up. I want to bring in Leia here for our next segment. Leia is our senior investment associate as well at King's Crowd. We're going to be talking about this week's chart of the week. I will pull it up on my screen, but for the chart of the week this week, we wanted to look at all of the testing the waters raises that have been conducted since 2023, just to see if there were any interesting trends that investors, founders, or others should be aware of. Now, when we took a look at the data, it just ended up being that because of the volume and because of the way that it's done through the platforms, most of the testing the waters raises that actually converted to actual live raises happened to be on two platforms, Wefunder and StartEngine. So for the purposes of this analysis, we did limit our scope of the analysis to those platforms. But if you take a look at the chart, there's a couple interesting takeaways. So shown here on the x-axis, you can see it's just grouped by platform. So Wefunder are all of the dots and bubbles over on the left. StartEngine are the dots and bubbles over on the right. The size of each bubble refers to the total capital that was raised when that raise converted and then finally ended up closing. So you can see here, one of the biggest ones, Atom Beam, raised $20 million, right, when they close. And some of the smaller ones, Bippo, I think this might actually be one of the ones that's still a live raise, but have raised 75K. So on the y-axis, though, where it's located vertically, is basically saying at the time that they were testing the waters, when they converted to a live raise, how much funds did they end up closing their campaign with? So 100% would mean that, hey, when we were testing the waters, we had 1 million reserved. And when we closed our final fundraise after we converted it to a live raise, we raised $1 million. Anything less than that means that the company is actually getting final commitments of those reservations less than the amount that was reserved during testing the waters. While above that line, if you're looking at anything like over on StartEngine above 100, that means all of these companies closed more than they had reserved during testing the waters. One of my first takeaways here, right, and I think one of the patterns you can see is just that I found it interesting that a lot of the StartEngine ones tended to raise more than the amount that was reserved during testing the waters, while most of the Wefunder raises reserved around the same amount, if not less. You can see Arrived was a huge fall off here, where they actually had less than 30% of the amount that was reserved during testing the waters.
I actually am a huge fan of the testing of the waters, and I think we talked about actually about it last week a little bit. I think I'm looking at this chart. I remember some of these deals. The Arrive deal, I feel like the slight asterisk was that there was some event or something that took place right around, not in like a bad way, but there was like some kind of news that came out where they ended up not taking in as much money or whatever. There was some reason. It was because like the campaign went well, and then I distinctly remember reading about some raise or something, that some new fund that they started that like it wasn't part of this, and there was some confusion. So that one I think might be.
That's a good point. That could be
I think that was like a bit of an outlier on that one.
Yep.
As for the rest of it, like I really think that this is the future of all this stuff, and not to go back into the Teddy conversation we had about the meme coin stuff, but like that's also kind of part of this. Like we're setting up a future where people can gauge interest from their communities as to whether or not they want to participate, not only in investment, but also in like the future of the business, new product innovation. You know, we've talked about for years that like crowdfunding is sort of a way to like market to your customers as much as it is to raise money. And like, while that's sort of true, it's actually kind of like not actually the real reason. The real reason is like having the ability to basically ask the community, what can we build for you? And like, you pay for it. And that's like one part, but then also in general, I do think everyone across this, whether your platforms or companies, founders, et cetera, you should basically apply the event RSVP rule to this. Like, you know, I don't think that's like weird or like speaks negatively about anyone, including investors, including the platforms, including the companies. Like, people all say they want something at one time. And if I have to wait 30 days later and my roof leaks, guess what? $5,000 investment I was going to put in Arrived is no longer there. So like, that's just part of the course. I would argue in the end, you probably benefit more by knowing that $7 million worth of investments are interested in this, knowing that probably 3.5 are like actually soft. And then like you make a decision as the owner or whatever, whether or not you want to proceed. So I actually think it's a really great tool for that.
Yeah. And I want to show two more quick charts that I just saw as patterns that were interesting. And this doesn't, like Scott mentioned, you know, some of these, there are asterisks next to all of them. Every raise has a unique story. But one of the interesting trends I mentioned or noticed is that on Wefunder, for example, versus StartEngine, they seem to appear to handle testing the waters reservations and the way they confirm them after differently. So on Wefunder, you see more of a pattern like this, where it tends to go from testing the waters to live, and then it either slowly drops off, which is maybe reconfirmations, or maybe it's people confirming less or investing less than they committed until it closes. Sometimes all of that drop off happens at the close. So it could just be kind of a way that they account for those funds, where they wait until the end before saying, okay, this person's actually not going to invest what they said, before dropping it off. That is in contrast to StartEngine, where basically the day after a raise converts from testing the waters to live on StartEngine, they start at zero again. And so those reconfirmations have to start building up as investors go back. As an investor, if you say, hey, I'm willing to invest $100 during testing the waters, you have to go back legally and confirm that before the round actually closes. Now, it could be, and again, this is all just speculation, right? That having some of this positive momentum, right, when they start with zero and they start climbing again, may give that impression of a positive raise momentum, which could attract more investment dollars. Now, one of the other big differences I will just point out, right, is that a lot more of the raises that were on StartEngine were also Regulation A campaigns. So Reg A tends to be more mature companies, tends to be companies that have more capital to potentially invest in marketing and outreach. So that could be another difference for why a lot of those StartEngine raises kind of went above and beyond the testing the waters amount, where more of the Wefunder ones tended to finish where they were reserved or a little bit less. All right, let's head back over to Leia. Leia, what do you think about all of this in terms of any thoughts or takeaways?
I think it makes sense for founders to do test the water because setting up a Reg CF, especially a Reg A deal, can be very expensive. Reg CF is going to cost a couple $1,000. Reg A can cost a couple $100,000 to set up. So it's very good for a company to know whether they can actually have traction on the market before spending all of that money, before spending time, which is also very valuable resources in startups, into setting up a Reg CF or Reg A deal, and before actually launching a deal. And what I'm seeing here is that except for Flutter Pads and Beeple that raised less than $100,000, it looks like all of the other companies we have here raised around $1 million or way more than $1 million. So it seems that test the water can actually be beneficial. There may be kind of, as you were saying, some momentum effect behind that. Maybe having a soft commitment is a bit less of a problem, kind of a mental barrier for people. And maybe once they engage into a test the water, they may have kind of higher chances of investing than if they would just have to already get out their credit card very quickly at the very when they make that investment decision. So it does seem like test the water is interesting for founders. Now I'm wondering how much time does that take from them? Is there any cost that is associated with that? And I would also be curious to know what is the amount of test the water that actually never convert to a deal.
Yeah, that's a great point just to address that, because all of the ones mentioned here, we did focus the analysis on raises that converted and then were successful. There were actually dozens that did not convert, that never filed their Form C, that decided not to raise, or that weren't successful. So we didn't include those on this data, but to give you an idea of ones that we've tracked, there's been more than 100 over the past few years. However, even King's Crowd, right, we can't track hundreds of these that are live at any one point in time because most of them have $0 raised or like $100, right? So what we usually do now is, as a company, we're only looking at raises that really at least show some minimum amount of traction. Say they get 25K or 50K in reservations. Once they get to that point, we're like, okay, there's enough actual interest here where we can start tracking this, where it likely or most likely will convert to a live raise. Scott, any other final takeaways from you in terms of this?
Well, for one, I just want to tell you, you build a damn fine product at King's Crowd. I think that's awesome that you can actually show in red the drop off and people can see that. Yeah, look at that. That's awesome. You're a maestro. And then the last thing is kind of just really summarizing Leia and Brian on this. I mean, the reality is, I think it's a good thing when there's 100 companies that try to find out if they should raise and then find out it's not the move and then they'll do it again. I don't think it's any different than a traditional IPO. You hear so-and-so is expecting or prepping to do an IPO at the end of blah, blah, blah. And then they hear back that no IBs or no one jumped at that. And then they got to go back under the covers again. And this has been something that I've called basically a mini IPO from day one when you talk about Reg A plus at least. So no different. And I think for our sake and for our investors' sake, and the members of King's Crowd's sake, like, I really think that we are getting like closer and closer to being operated very similar to like traditional finance in the best way possible. So like, I think it's really any protections that get added to this program, I think is better.
Awesome. Yeah, we really, I mean, at King's Crowd, we really want to give you as investors more of that data, because sometimes it's not always apparent when you're on a platform. Are they actually testing the waters? There are ways to tell, but you have to kind of search and look in the footer or know, the difference and what that means. So hopefully now it gives more insights when you go to invest, where you can actually see the history of, oh, they were actually testing the waters before, that's why there was a drop off, or oh, they just converted, that's why it's maybe not a lot invested, or vice versa. If it's a platform where, hey, they have a lot of money, but maybe this is going to go down by the end because of the way they reconfirm. It's just something you need to have as a decision-making criteria before you go to make that investment. So again, all those charts that we just showed are completely free. So if you haven't already, make sure you check out kingscrowd.com. You can get all of these charts, the data and the analysis for free. We also have some premium products available for purchase where you can sign up for just $15 a month and you get access to all of our deep dive ratings and analytics. We break down every opportunity from 1 to 5 stars, helps you sort through the noise of all the deals that are out there at any one point in time, and also gives you the input of our amazing investment team here, Teddy and Leia. So with that, I think we will sign off for the week. Again, make sure you head over and check out kingscrowd.com, sign up for our newsletter if you aren't already, and we will see everyone back here for next week's roundtable.